Today, more muddling through a terminal dilemma. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian flavour. Well, last Friday, the new British Chancellor Kwasi Kwarteng unveiled $45 billion of annual unfunded tax cuts that sparked fears the national debt in the UK would spiral out of control. The measures included tax cuts, unfettered bankers' bonuses and other incentives to drive growth. Deregulatory packages for the financial services sector, planning, agricultural, telecommunications and childcare are only due after the party conference recess and before the Office of Budget Responsibility publishes its independent assessment of the public finances on November the 23rd. The government has said it will wait until the OBR forecast to publish its fiscal framework, which will be a combination of fiscal and growth measures. So, all we got last week was a high-level pen picture with no detail, no forecasts, which is, by the way, why they didn't call it a budget. But not only was this a major shift from previous government policy, but it triggered concerns that it might be inflationary. Markets reacted badly, as we report in our weekly wrap, and continued to drive bond yields higher. Remember the inverse relationship between bond yields and bond prices. See my earlier show on bonds if you want to understand how those IOUs work and are priced. Long-term bond yields rose significantly, as can be seen by the plot of the UK 30-year bonds, and significantly these instruments are used to price mortgages and to cover exposures for pension funds, so they drive the momentum in the financial markets. And so, no surprise at all on Tuesday that markets were roiled and continued their bear market slides, not just in the UK but around the world. The fallout was significant, with people thinking the Bank of England would have to lift interest rates perhaps up to 6%. And meantime, many lenders stopped writing mortgages while pension funds and hedge funds were forced to sell bonds as the prices fell, causing a self-reinforcing downward spiral. Also on Tuesday, the Bank of England chief economist Hugh Pill said the bank's programme of government bond sales should go ahead as planned next week if the market repricing stayed orderly. But then on Wednesday, it all changed. We had a series of events that really shocked the markets. First, the IMF openly criticised the UK government over its plan for tax cuts, warning that the measures are likely to fuel the cost of living crisis. In an unusually outspoken statement, the IMF said the proposals were likely to increase inequality and to add to pressures pushing up prices. The IMF, of course, is normally dealing with developing countries and applying a neoliberal philosophy, seeking to cut spending, reduce debt, and to bring struggling economies back to health. And financial help, when it's offered from the IMF, is often predicated on them taking specific and often unpopular measures. So, when the IMF specifically called out the UK for its policies, the writing, well, was on the wall. Not much later, the Bank of England announced that they would be carrying out unlimited temporary purchases of long-dated UK government bonds from 28th of September, in other words, Wednesday. The purpose of those purchases will be to restore orderly market conditions, they said. They are seeking to stave off the crash by unlimited purchases of gilts. The purchases will be carried out on whatever scale is necessary, the central bank said, language reminiscent of former European Central Bank President Mario Draghi's 2012 pledge to do whatever it takes to save the euro. And bear in mind, there's around £1 trillion worth of liability-driven investment strategies that are invested in government and corporate bonds. The Bank of England feared that a sale to meet collateral demands would push prices lower and bankrupt some funds, forcing more sales and ultimately triggering a negative doom loop. And the decision to break the potential run was taken on concerns that the chaos in long-dated gilts would spread across the entire gilt curve. As a core market on which business loans and mortgages are priced, the dysfunction would have led to far wider economic fallout. And they did this because the central bank had been warned that collateral calls on Wednesday afternoon could force investors to dump government bonds, driving prices lower and yields higher, leading to even more upward pressure on interest rates. It was a doom loop because collateral requirements on liability-driven investment strategies, such as those at pension funds, would have turned many into forced sellers of long-dated gilts, and the cash call would have happened Wednesday afternoon, turning the market one-sided and risking a precipitous collapse as funds were forced into a fire sale of assets. Investment banks and fund managers have warned the government in recent days of this liquidity problem. The central bank warned that continued dysfunction would threaten financial stability and even damage the economy. So the Bank of England kicked off the plan on Wednesday by purchasing just over £1 billion worth of securities maturing in 20 years or more. By the way, that was less than the £5 billion that it said it was prepared to buy at each auction. And operations will continue every weekday until October the 14th. After today's auction, that meant the bailout could reach, wait for it, £61 billion. The announcement of the purchases had an immediate impact on the gilt market, sending 30-year yields on their biggest drop on record. They earlier climbed to the highest since 1998. And the rout in bond markets stems from the government's determination to push through the biggest package of unfunded tax cuts in half a century in the face of widespread opposition from economists and investors. And the IMF had on Tuesday urged Truss's government to reconsider the plan, and Moody's Investor Services warned that it could threaten the country's credit rating. The bank said the purchases will be strictly time-limited and are, quote, intended to tackle a specific problem in the long-dated government bond market. The Bank of England's intervention, which will be financed by the creation of new reserves, is a market maker of last resort operation, but looks like open-ended quantitative easing. The distinction is in the intention of the policy and how quickly the Bank of England sells the gilts back to the market. While QE is normally a monetary operation, the step was recommended by the Bank of England's Financial Policy Committee amid fears of a material risk to financial stability that would lead to an unwarranted tightening of financial conditions and a reduction in the flow of credit to the real economy, the Bank of England said. Even so, it will have consequences for monetary policy and could mean officials decide they need to act in a bigger way in November, when markets are already pricing in about 170 basis points of interest rate increases. QE was one of the policies criticised by Truss and his supporters during the summer's leadership contest. The MPC will make a full assessment of recent macroeconomic developments at its next scheduled meeting and act accordingly, the Bank of England said on Wednesday. The MPC will not hesitate to change interest rates by as much as needed to return inflation to the 2% target sustainably in the medium term, in line with its remit. The intervention buys time for Chancellor Kwasi Kwarteng to reconsider the government's policies and for the MPC to take stock ahead of its November meeting. Now, we can probably expect 100 basis points on the 3rd of November, with risks skewed to a larger, earlier move. Now, as a result of all this, the yield on the 30-year bond fell to 3.974% on Wednesday, having been close to 5.1%, and 10-year yields fell to 4.05% from 4.62%, and the pound rose 0.8% to 1.0823, having been as low as 1.04 earlier against the dollar. The FTSE was up to 7,005, having been as low as 6,845. Now, the return of bond buying comes just days before the Bank of England was due to start selling the mammoth holdings of government securities it had built up since the financial crisis, which peaked at £875 billion. And it said that it would now postpone the plan until the 31st of October, but the annual target would be for £80 billion worth of reductions, and that was unchanged. The UK government hopes that the Bank of England's intervention to stave off a market crash on Wednesday will buy time to rebuild confidence in the disastrous mini-budget, but their action is simply money printing, pure and simple. They went on to say that the Monetary Policy Committee's annual target of the £80 billion stock reduction is unaffected and unchanged. So they're pulling both ways at the same time. The bank's executive has postponed the beginning of the gilt sale operations that were due to commence next week. The first gilt operation will now take place on the 31st October and will proceed thereafter. Well, we will see about that. It does sound like the Bank of England is actually trying to have it both ways. QE to save the bond market and QT to save inflation. So can they really do both? And as Zero Hedge put it, the terminal dilemma is this. You can fight inflation and suffer market collapse and economic depression with millions laid off, or you can push to stabilise social order and employment with higher asset prices and runaway hyperinflation. So it really does highlight the horns of the dilemma that central banks are actually facing at the moment. And we suspect that we are close to a Lehman's moment over the next few days. It'll be very interesting to see what happens as liquidity was crashing, and yet with high inflation, can they cut rates? No, they probably can't. So can they do more QE? Well, yes, they can, but there are consequences if they do that. Now, in the UK, City Minister Andrew Griffith attempted to calm nerves in a pooled interview with broadcasters. Every major economy is dealing with exactly the same issues, he said. What the Chancellor and I are focusing on is delivering that economic growth plan. And pressed on whether the government would reverse any of its fiscal decisions, Griffith said, "We think they're the right plans because those plans make our economy competitive." Now, Colin Pickering, UK economist at Berenberg Bank, said that the Bank of England's actions had bought the government time to fix its credibility. And Kwarteng is expected to use the reprieve to explain his strategy more clearly and publish details of supply-side reforms rather than the U-turn on tax cuts. And as the government puts flesh on the bones of its reforms, it expects pressure in markets to ease. The plans are designed to help the Bank of England bring down inflation, as raising the economy's potential growth rate is the most sustainable way of curbing price rises. Now, global markets enjoyed a break from the brutal selling that had gripped them since the Fed embarked on the most aggressive path of interest rate hikes since the 1980s. The S&P 500 snapped a six-day rout. It rose the most since early last month, and for the first time since the Federal Reserve boosted rates and dialed up its hawkishness a week ago. The index jumped more than 2% later in the session, also bolstered by gains in Amazon's shares after the company's annual device event on Wednesday showed it pushing further into wellness, security, and the auto industry. The 10-year US Treasury yield dropped towards 3.72% after topping 4% earlier. Oil advanced with metals, and orange juice futures spiked as Hurricane Ian barreled ashore in southwest Florida. Fed officials remain diligent in warning that more rate hike pain is yet to come, though, with Atlanta Fed President Raphael Bostic and Chicago President Charles Evans reinforcing the hawkish stance that colleagues had been hammering home all week. All eyes are on inflation and interest rates, and this renewed hawkishness or more aggressive hawkishness from the Fed has certainly set equity markets into a period of concern here, said Josh Emanuel, Chief Investment Officer at Wilshire. From this point forward, equities are really going to take their cues from bond markets. So if you see bond yields move lower, that's a good sign for equities. Stocks may also be rising because the markets have priced in the Fed's hawkishness, according to Adrian Helfert, Chief Investment Officer at Multi-Asset Strategies at Westwood Holdings. It's harder for the central bank and the speakers to say much more, short of saying that they're going to start hiking by 100 basis points for the next several meetings, he said. Maybe the market is at least now believing what the Fed is saying. But economists are still worried that the central bank is committing another error after being too slow to respond to inflation, since a series of jumbo rate hikes means officials are not weighing the impact of their actions are having on the economy. And geopolitical tensions also continue to simmer, with natural gas prices in Europe surging after Russia said it may cut off supplies via Ukraine, and the German Navy was deployed to investigate the suspected sabotage of the Nord Stream pipelines. While the European Union proposed a new round of sanctions on Russia, the growing exodus of Russians fleeing President Vladimir Putin's mobilization order is creating turmoil at the borders with neighbouring states and stirring fears about potential instability. Now, any rally in the face of these challenges will likely be met with scepticism, given the dual headwinds of rapidly slowing global growth, pressurising earnings, and increasingly tight liquidity, pressuring valuations, said Cameron Dawson, Chief Investment Officer at New Age Wealth. The dollar dropped on Wednesday, but its recent rally brought losses to other currencies, including the euro and the onshore yuan, which tumbled to its weakest level since 2008. And a regulatory body guided by the People's Bank of China urged banks to protect the authority of the yuan fixing. And fast and furious Federal Reserve tightening risks slamming the economy into recession, with economists worrying it's committing another error after being slow to respond to rampant inflation. A string of jumbo-sized 75 basis point interest rate increases, which the Fed signals it will continue in November, means officials are not waiting to see the effect of their action before acting again. They're moving so fast, there's not a lot of time to evaluate the impact on the real economy, Jonathan Pingle, UBS Group AG chief economist, said. Given the lags for some of this inflation data, that's kind of a concern. Officials only began raising rates from near zero in March after pricing pressures were already mounting. And after being slow off the mark, they're now front-loading increases to catch up, with the cost of the first mistake being the economic pain inflicted to squash inflation. The Fed has raised rates by 3 percentage points this year, with the bulk of that coming since June, and has vowed to continue hiking until it sees clear signs that inflation is coming down. And while it has already pushed up the cost of borrowing on everything from home loans to cars, the full impact of those moves won't be known for months, given the time it takes for monetary policy to work through the economy. By not building in some breathing room to see if the actions they're already taking are bringing down inflation, policymakers risk causing a bigger slowdown than necessary and potentially more harm than needed in the labour market. But Fed officials indicated at their meeting earlier this month that they'll raise rates by another 1.25 percentage points this year, and that could mean another 75 basis point hike in November and a half percentage point increase in December. Rates will then go up another quarter point next year, according to the Fed's median projection. Such a move in November would mark the fourth straight three-quarter point hike. This risks trapping the Fed in a hamster wheel of ever larger rate increases, Evercore ISI economist Krishna Gua and Peter Williams wrote in the note after the Fed's September meeting. The economy, which has so far appeared fairly resilient to the Fed's actions, is starting to show some signs of cooling demand. Apple is reversing plans to increase iPhone production amid lower demand than it anticipated. Policymakers who view their role in bringing down inflation as critical to their credibility have acknowledged that this amount of tightening is likely to cause pain to US households and businesses. The Fed can only directly impact the demand side of inflation, or how much spending power or appetite for spending people have, so a key channel to curb that is via high unemployment. But the labour market has been strong in the past year, with unemployment low and many more job openings than people looking for work. That should help it weather some of the Fed's actions, policymakers argue. Still, it is a delicate balance, trying to navigate that to bring inflation down, while we do so as gently as possible, not to tip unnecessarily the economy into a downturn that actually influences the full employment part of our mandate, is a struggle, San Francisco Fed President Mary Daly said in a virtual event on Tuesday. She said it's important that the Fed navigates through this high inflation environment as carefully as we can, so as not to cause long-term damage to the labour market. The Fed says it wants to cool inflation without causing long-term damage to jobs, even a relatively small impact to the labour market. The Fed currently estimates that the unemployment rate will rise to 4.4% later next year from 3.7% now, will mean lost jobs for more than 1 million people. And past crises have shown that losing a job during a downturn and long bouts of unemployment can have lasting implications, sometimes lifelong, for impacted workers. Atlanta Fed President Raphael Bostic said he'd avoid overdoing it on rate hikes, by stopping before inflation gets down to the Fed's 2% target. I don't think it'll be appropriate for us to continue to tighten and increase your rates until inflation gets to 2%, he said on Wednesday. That will be guaranteeing that we've gone too far and will take the economy into a negative space. That may prove difficult to execute in practice, though, by not slowing down rate hikes right now. The Fed is also in danger of not being able to justify the pause it has penciled in for next year if inflation remains high at that point, according to Stephen Stanley, chief economist at Amherst Pierpoint. Officials are clearly laying the groundwork to end their rate hikes at a point where the rate of inflation is still far too high, Stanley wrote in a note last week. I'm sceptical that the financial markets and the general public are going to be willing to go along for the ride, with the Fed having little to show for its efforts at that time in terms of getting inflation down. So once again, here we are on the horns of the dilemma. Do you lift rates higher to try and get inflation under control and risk high levels of unemployment? Or do you turn turtle and effectively go like the UK is going, with a little bit more quantitative easing just to oil the wheels of commerce and to protect the financial stability of the markets? These are the dilemmas now that all central banks around the world are facing. And the problem is, there is no simple way out of this trap. This is a trap that has been created by 20 years of bad policy and 20 years of too low interest rates. And at the moment, I don't see a way out. We are in a cul-de-sac, so we're going to be bouncing around between those two options for quite some time. And I think that the UK is a case study in point. As for whether this is really a Lehman's moment, or whether it's just another piece of muddling on, well, we'll see. My suspicion is that we'll be muddling along for quite some time yet. But unfortunately, there is no clear exit strategy, and there is a huge risk of policy missteps that could take us directly to a Lehman Mark II. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.